Hello, welcome back. In this video, we are talking about a company that I have never talked before in my channel. It's Gilead. It's a pharmaceutical and it's a company that I think is rather interesting. And in this current environment where we're having high inflation and we're having a potential for a deep recession potentially, owning some healthcare companies may not be a bad idea. Healthcare companies are not cyclical. We need medicine to survive, and people buy medicine throughout every year, throughout every season, throughout every circumstance. It's one of our core needs, and this is why a company like Gilead can actually do well despite a recession, if that actually happens. Although we are probably already in it, but yeah, again, I mean, if it actually widens. Now, the company actually reported earnings, and we're gonna examine those earnings as well just to see what they did. But they are up 3.7% as at the time I'm making this video. I actually want to refresh because the earnings report is actually today, so this changes quite significantly sometimes in the after hours market. So far it's the same. But we're gonna be taking a look at a company that hasn't really lost any of its value. Again, remember, this is not a cyclical company that is bound to do well, even if the whole stock market is crashing. It can still do relatively well compared again to the overall market, because again we needed to survive pretty much these kinds of companies. Yet you're likely not going to be having some explosive gains with these kinds of companies. Like you can see the 5 year chart, they are paying a dividend though, so this is important. So you can be making some money out of that. And pharmaceuticals do tend to pay dividends because of that matter, because they are not actually really growing that much, and they are not like companies that are reliant on a booming market pretty much. And you can also take a quick look at the max chart and see that the company has been growing tremendously through many years, and then kind of slumped a little bit for the last decade or so, where everything else was booming. So bear that in mind when you're looking at these companies. Yet still, it can be a nice company added to a portfolio that keeps paying you, so a dividend-based company. So let's take a look at what happened at the earnings report first. So you will see here Gilead stock rises on more upbeat forecasts, while COVID drug sales slide 52% for remdesivir over here. And you will see that the reported net income of 1.79 billion or $1.42 a share is compared to 202.59 billion or 2.05 per share in the prior year quarter. So there is a decline over here, as you'll see. Sales were 704 compared with 742, and Gilead earned 1.9 earnings per share compared to 2.65. So this is actually down than what it used to be 1 year ago. And treatment and prevention markets continue to grow with further share gains from some medicine here. I don't even want to pronounce it. Is what the CEO of the company actually said in his statement. Now, some HIV product sales rose 7% over here. Remdesivir actually fell down, as you'll fell 52%, as you'll see, as there are less COVID hospitalizations, is what we're seeing over here. And executives for the company also raised their sales and profit outlook, and this is obviously very important, the guidance. And so this is probably one of the core reasons why we're looking at better results in terms of the stock price and not worse than expected. Management said it expects total product sales of between 25.9 and 26.2 billion, up from the prior range of 24.5 and 25 over here, and an an adjusted EPS of about 6.95, between 6.95 and 7.15, which is much higher than the previous expectation, 6.35 to 6.745. And this probably makes a pretty big difference here in terms of what's happening with the stock price. And the 4 year forecasts were an EPS of 6.51 and sales of 25.28 billion. And the shares of the company rose 1.9%. So what's going on? Let's take a look at our metrics page here. Let's see what is going on with the company. Now you will see here the P ratio of the company is sitting at 21.5, and the price to free cash flow at 8.15. So many adjustments for free cash flow here, giving a different picture of the net income and the price to free cash flow, which we will examine, of course, in a little bit more detail. The company bought a few shares, not too many over here, but still buying back some shares. And it's very solvent, and their revenue growth, again, is what I told you earlier. These companies are not really growing tremendously through the years, and they had a year where they actually spent a ton of money for settlements. We'll see that. Net income also growing at a pretty nice pace, though, 34% in the last 5 years is not bad. And free cash flow is actually negative, not growing, frankly, and it's actually at about the same rate as it was 5 years ago. And total equity growth, again, pretty similar, not much difference over here. Now, the net income margins for the company are 12%, about 12% right here. And the company is paying also a 4.1 percent dividend, which is one of the most important things for a company of this sort, understandably. Now, the free cash flow payout ratio is 33%, but the payout ratio in terms of the dividend of the net income is 110 almost. And so this is interesting here. If we take a look at the dividends tab here in our tool, you'll see that the company has been paying dividends not for too many quarters already, and they have been increasing their dividends overall, although the rate of increase seems to be going down a little bit over here. It used to increase it a little bit more, it looks like. So maybe some troubles in the future. It looks like the ratios are a little bit high. We will examine that a little bit more. Like if you take a look at the income statement from 26 billion in revenue to 27, so the company is not really growing over here. This is not a growth company. And in terms of the net income margins, 4.6, 5.3, and 123 million here in 2020. So what happened in this fiscal year? And of course they went back. But I researched that a little bit because I wasn't aware of why their net income is that much lower here. But I had a hunch that this was probably some sort of a lawsuit, and it turned out to be the case. Let's take a look at this article. So Gilead earnings hit by legal settlement, other charges. You can see it in their investors relations page. I checked that too, just to verify. But Gilead reported like 69 cents per share versus 2.19 a year earlier because of this charge that they had here for, some sort of a bill that they had to pay, pretty much. And yeah, this happens a lot with these kinds of companies, the pharmaceuticals, and you have to be careful about that because they can have some pretty significant lawsuits, and they can spend a ton of money because of that. So be careful a little bit about this situation when you are entering these kinds of companies. Now they went back to their normal 6.2 billion over here in net income, and if we take a look at their balance sheet over here, you will see that their total liabilities are at about 46 billion, about what they were like 5 years ago, a little bit less actually, and from 20 billion to 21 in terms of total equity. It's a company, again, that's not really growing. It's basically paying you the dividend, and maybe you can get a little bit of growth, if you buy it at a cheap price, which doesn't seem to be the case here, like 70 bucks. This has been at about the same one like a year ago. So yeah, again, it's not a company that moves much. It's a company that pays you pretty much to hold it. And in terms of the operating cash flow, 11.3 billion here. Again, what they used to do like 5 years ago, not much of a difference. And remember, in between these years, there has also been some inflation. So you would like to have at least some increase here, while you do have a decline pretty much overall. Now, cash from investing activities, losing some money here, deliberately, of course, investing in stuff, acquisitions, purchasing of investments here. So overall, they seem to be purchasing in the last few years. Actually, this year they actually sold more. Okay. And in terms of dividends, which is the most interesting part, they paid 3.6 billion over here, up from 2.7 5 years ago, and their free cash flow hasn't been increasing. So 11 billion here and 10 billion. So this actually is starting to get a little bit annoying, like from again 2.7 to 11, and then 3.6 to 10.8. So it's getting a little bit tighter here. I don't know if you can feel it. It's still not that tight, but it's definitely a little bit tighter. And yeah, the net income of the company here, you will see that again, 2020 you cannot really take into account because they had this issue with the lawsuit. But you will see over here that 11.3 is what they did in operating cash flow, pretty much, after adjusting for a lot of depreciation, amortization, and quite some stock-based compensation here, which increases the overall operating cash flow, as you will see. So interesting to see that. But yeah, still the company looks like it's they can rather easily pay out their pretty much their dividends using their free cash flow. And again, their net income comparison to their dividends that they are paying has been affected significantly by the quarters that they lost pretty much a lot of their net income because of the actual lawsuit. And so you cannot really take that into account that much, but you can actually examine exactly what's happening here with the free cash flow and how much they're paying in dividends and get a clearer picture. It looks like they're fairly solvent, and they can rather easily pay the dividends so far, yet it's getting a little bit tighter, is what I told you earlier. Now, what price to pay for this little thing? Now, the revenue growth of the company has been here and there, like it has been losing some, then gaining some. I took a look at analyst estimates and they are expecting some declines here. And so this is why I'm going to go minus 3% for my low estimates. Then I'm going to go 0 and then 3% in the case that the company actually makes money. And for the net income margins, I'm gonna use something close to 23% is what they have been doing lately. Now, again, in the previous years, they have been doing worse than that, but you can't be affected that much by the year where they actually have the settlement because the margins there would have been terrible, and the growth would have been terrible as well. Take a look at this margin over here. Again, that happened because of the lawsuit. But you can see that over the years, the company has been having 24, 23, 22. So this is what it makes sense to use, like 22, 23, and 24. And free cash flow margin, over here again, you cannot get too affected by what the company has been producing in some years, like for example this one or the odd one now over here. Yet overall, they still do significant free cash flows compared to the revenue that they are generating, which can be a little bit of a weird thing because it happens because of adjustments for depreciation, amortization, things of that sort. And so you have to be a little bit careful about going overboard. I don't want to go too overboard with free cash flow margins over here, so I'm going to use something that is closer to the net income that they are generating. I'm going to go 100, 110, and 120. And an annual return of 13% is what I typically like to use, and I'm going to use here. So I hit calculate, and what am I getting? So the company is not a buy over here at a low of 55, but it's a buy at the 73 and the 94 medium and high estimates here. The current price is going to be at about maybe 71, 71.50, something of that sort after the market opens. So it would be a buy for the medium estimates of 0% dividend growth, revenue growth. So what I'm saying about this company is that it may still be, not the cheapest thing to buy, but it's not expensive either. And I'm not sure how much it's going to be declining. Again, remember, these kinds of companies don't really decline that much. It could decline a little bit. Now, 72.50 is the current price. And it is a company that if you're looking to add a fairly safe dividend to a portfolio that's going to last you for a while, this may be just a good addition. But for a company that's going to grow, I probably wouldn't be adding this to a portfolio and just avoid it overall. And the thing is, again, if you are looking to get some money, and pretty much have it through the pandemic period, actually the exiting pandemic period, and I should say the recession period, maybe it's a good addition to portfolio. But do tell me what you think. Do you own Gilead? Buying it for the dividend? What do you think about this company? And remember to leave a comment below, and remember also to like the video, that helps a ton, and subscribe if you're not a subscriber already. And as usual, become a Patreon and gain access to our tool if you are interested as well. All the links for everything I have said in the box below this video. And I'll see you in the very next video, guys. Bye bye.